Yeah, good morning again. So this thing that um, things will not go as you expect, go right as you expect. Okay, it has got certain implications in financial market, in my opinion. Okay, when you forecast about the share price, okay, so what happens? Suppose your forecasting happens to be correct. Suppose some one of you, let's say, ask Ijazur. Ijazur, are you there?
Yes, sir,
Ijazur,
I am here.
yeah. Suppose Ijazur predicted about a particular stock price, let's say XYZ stock, and say this is going to be traded tomorrow at rupees 230 per share. And Ijazur was found to be correct on tomorrow morning when the opening bell came. So that opening bell made the first transaction the market opens. So their trading was done around 230 rupees, not exact 230, but 230 to 31 to 32, something like that. So then obviously so many people had forecasted and only Ijazur's forecast came right. So Ijazur became very good, advisor, financial advisor. Not only that, again, for tomorrow, next day also he predicted something and that also happened to be correct. What will happen? Now everybody will go to whom? Ijazur, correct?
Yes, sir.
Right or wrong? And similarly, then people will think, what is the Ijazur knows that I don't know? So they'll think about it is not rocket science at the end of the day. So they'll also think, try to do how he does all those things, try to find out some way. They'll also try. And they are forecasting also about a particular stock price to be correct. That means what? Ijazur, Yas, Pragya, Harshavardhan, Himanshu, Govinda, Shravanti. By the way, Govinda is my PhD student who is there to observe and help me as a teaching assistant. Govinda Gopal Pahadi. Govinda, can you show your face so that people know? Although you don't see them their face, but they can see your face. Govinda is in hostel now. Govinda, you are mute, I think. Maybe you have to remove that. But anyway, so like next time we can see your valuable voice. Okay. Okay. He is a PhD student. He is in the second year of PhD, going to PhD in finance and accounting area. Okay, Govinda, you can switch off your video, no problem. Right. All right. So all of them forecasted that the company X price is something and everything will be correct. Now what will happen in the market? Tell me. If all the forecasting seems to be correct, then what will happen in the market? What will happen? Hmm? Any idea? All your forecasting appear to be correct.
So prices won't move.
Prices won't move. Okay. That means if I draw the line, I can draw a line also though. So maybe share price will be like this, you expect, but then you see share price goes like this. Okay. This is your time. This is your price. Everybody forecasted. Now what will happen in the market? Tell me. What will happen in market? If prices don't move, what will happen? Eventually, no trading, correct? Or trading only for liquidity. That means somebody has some share and he wants to sell the share, you can sell possibly, and there is a buyer who will buy. So because he needs cash, liquidity. Otherwise, somebody was thinking there will be gain, loss, accordingly some speculation, nothing will happen. Okay. Now, what is this market known as? If all the forecasting appear to be correct, what is market? Your share price becomes what? Parallel to, your share price is now parallel to x-axis, correct? Right? What does it mean? You have seen in Hindi movies, typically in Hindi movies, they'll say some graph somewhere in some establishment, ding, 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 then like this. What does it mean? What does it indicate in the Hindi movie?
Equilibrium. No.
Hindi movie I'm saying, sir, not equilibrium.
Dead.
I don't know which Hindi movie said equilibrium. Yes, tell me. In a movie, when they say, instead of showing the person, they'll show the screen, which will be where the graph is there and graph will be fluctuating, then it becomes a straight line.
Dead market.
Market is dead. So, essentially to make the market live, the forecasting of share price should be wrong or should be different from one person to another person. So, in a nutshell, whenever do a valuation and forecasting, do not expect that your valuation is to be correct. If your valuation forecasting is correct, then anyone also can forecast that way and it will also be correct. It will lead to actually no trading in the market, no trading, no fluctuation, no volatility. All your futures, option, derivatives will go for a toss. Okay. Anyway, always you try to forecast the share price so that you can go take a buy position, sell position, make some gain or something. That is always the interest of the investor. Okay, some people think share price will go up. Some people think that share price will go down. So that's why they have bull or bear position. All those things we'll discuss maybe sometime later about those things. That is the way. Okay, so in a way I talked about that. Yes, your valuation. We'll discuss about the valuation of shares in some other, maybe next week. And there we'll talk about a visit again. It did not be always the valuation is going to be correct as such. Valuation can always go wrong. That's why consultants give a range of valuation. They don't give a particular price as a valuation. They'll say, okay, within this meant this much. Because there are so many subjectivity involved in your forecast, and your forecast can always go wrong. Okay, so let's go back to our spreadsheet. Interest, just a minute. Let me stop sharing this and stop sharing something else. Any comment on my observation? That is my personal observation. You may agree or disagree also. Not neither that you have to agree with my observation about those forecasting evaluation. Yes, anyone? Let me before by the time I open the file. All right. So we are talking about that interest coverage ratio. High interest coverage ratio doesn't mean that you can comfortably pay the interest. Can somebody elaborate? Does somebody have any idea? What is that I mean? Yes, anyone, please go ahead. Yes. Yes. Any answer?
So regarding the explanation, like why is it happening?
No, I'm saying no, not about that market. I'm saying high interest coverage ratio need not mean. We said that interest coverage ratio means you are going to be comfortable paying the interest. That's what, because you have earned as much profit. Suppose if interest coverage is 5 versus 10 or 5 versus 8 for two different companies. So we can say that this company A ICR is 5 times and company B ICR is 8 times. So we say that this company is more comfortable paying the interest because it has on 8 times PBIT to pay 1 rupee of interest of 8 times. That means 8 rupees profit of PBIT on to pay 1 rupee interest. So possibly company B is going to be more comfortable paying the interest. That's what I meant. Okay. But my question, I'm on counter argument is not necessary that company B will be more comfortable. In fact, company A may be more comfortable paying the interest. Anybody can guess, anybody can think. I'm sure some of you can answer this question. No one? Think, 30 seconds. No one. Let's say to pay interest, what do you need actually? How do you pay interest? Can you please tell me if you want to pay the interest, what are the 2 things will be affected as per our accounting equation? When you pay interest, what are the 2 things affected? Yes. Suppose you have to write. We did that in our example. We had an interest payment, right, on the loan taken by Nidhi from her parents, from her father. You remember that? When you pay interest, 2 things were affected. What are those 2 things in the accounting equation? You don't remember that? Anyone? Well, you have taken a place not to speak or what? Whom do I ask? Somebody has to answer, otherwise I'll still sit quiet. Guess, make a guess. When you pay interest in accounting equation, what are the 2 things going to be affected? Recall those columns.
Asset and liability. So asset and liability. Assets and liability.
Liability, why will be affected when you pay interest?
Like
liability, why liability affected?
Reduce.
Pardon?
Because we are paying off the loan and like loan.
No, you're not paying the loan. You are paying interest. You're not paying the principal.
Okay. Just.
Okay. When you pay principal, the loan amount will go down. But when you pay interest, which asset will go down, by the way? When you pay interest?
Like whatever we use, maybe cash asset or
cash
something.
only. You pay interest in what? Not in kind, na?
Yeah.
So cash will go down. And corresponding on the liability side, equity side, something what will go down? Indirectly or directly? Interest will affect what? Interest, any expense will affect what?
Retained earnings.
Retained earnings.
Retained earnings will go. That means it is taken out of profit indirectly, right? Your profit will decline, so retained earnings decline. Indirectly, with payment of interest, your equity will go down. Anyway, not a problem. So finally, you require money in a cash. Okay. So can I say that I have earned more profit before interest tax means I have more cash with me? Can I say that? Tell me. PBIT is affected by what? Revenue and expenses. But all revenue may not be in the cash format. You might have collected them. Is possible or not possible? Or you might have collected more cash also. Compared to revenue means you have taken some cash as an advance from your customer, or you have a certain amount pending from your customer that you have collected. So that way, your cash availability may be higher in case of company A compared to company B. Company B, maybe most of them are credit sales and amount not collected from the customer, whereas they have paid the expenses in cash. What will happen in their case? Obviously, company B is going to be less comfortable because they may not have that much cash left over. They may have higher profit, but not cash flow, because your profit and cash flow are different. Okay. So it all depends upon how much cash you have, how much cash profit you have on. That will be more better indicator as such. So in that case, possibly one can go for an alternative metric for interest coverage ratio. Is what? Alternate metric for ICR could be cash profit divided by interest. That is supposed to be better metric maybe. So cash profit by interest expense may be higher in company A. Okay. And that company may become more comfortable than company B. I'm just giving hypothetical cases. It is possible that company having more in interest coverage ratio as per PBT by interest, also having cash profit interest also higher. That is possible. No problem. But I'm just giving that. Yes, it is not necessary that high interest coverage ratio companies are more comfortable paying the interest compared to low interest coverage ratio companies. That is my conclusion. Okay. Sure. Any doubt? How to find the cash profit? No problem. It will be income in terms of cash. Cash profit is before interest. Income in terms of cash minus expenses in terms of cash. That means depreciation is not going to remove because depreciation is non-cash expense. So to make a simpler one can possibly go to PBDIT also. Another alternative is PBDIT by interest. Assuming all income and expenses are in cash in nature, so profit before depreciation, interest and tax can be taken as a substitute for cash profit. Assuming that all my revenue and expenses are cash in nature. Okay, that can be also alternate metric for interest coverage ratio. Okay. So unless you have a doubt, I'll go to the next thing. That is talking about what? Unless you have something else to clarify, I'll go to the next one.
Why are we including before depreciation also?
Just a second. What is that you said? Why we talk about before depreciation?
Yes, sir. Why depreciation?
Because profit before interest and tax is after depreciation. That we have discussed in some other class, right? Remember that, na? PBDIT less depreciation gives you PBIT, correct?
Yeah.
But depreciation doesn't involve cash flow.
Okay.
So we need to know the cash profit. So let us take the profit which is before depreciation.
Okay. Got it.
Okay, that's right. Okay, I have one more question also. Somebody asked me that I also remember now, recall. Okay, let me go to the second question. That is your equity preference, etc., etc. Okay, so when you talk about share capital, normally we understand share capital means equity share capital. Okay, equity share capital means equal rights for the shareholders, and there is no promise with respect to promise or commitment or mention, for example, with respect to periodic return like dividend and principal repayment. That means company will give you back, which is there, but these things are there in case of loan or debenture or a bond where yes, interest. So this is not there, this is not there, whereas interest and principal repayment, those time was mentioned. in a loan or bond. There is a fundamental difference between share capital and loan or bond assets, or debt for that matter. Fundamental difference. Okay. Right? Yeah, loan can be different as well, but normally loan will carry an interest or coupon. That is also called coupon, and there will be schedule for principal repayment. That's what the primary feature of a loan or bond. Okay. Now, that means if you are an investor, you need periodic return, and also you need a commitment that I'll get back my principal money at some point of time. Then I'll go for what? Loan or bond, because equity doesn't give you that. Yes, we'll give you this much return at like a dividend. Equity side also doesn't mention that how many days it will take for me to get back the money. Yes, company can go for at certain point of time dividend declaration, which is not compulsory, but company may declare dividend and then you get dividend like any other shareholder. Similarly, company may go for buying back the shares from the market, which we'll discuss in some other class, where in that case, a company at all goes for that, you can participate in buyback means company will offer to take back the shares from the shareholders and give the cash. That's what. Otherwise, if you want to exit from the share capital investment, you have to go to the market. If it is listed, you go to the market and try to sell the share, and somebody else will buy the share. Company only come to know that yes, that such an serial number shareholding has been now transferred to some other person. That's what they know. When you buy or sell share, company's cash flows are not affected. It is your investor's cash flow is affected. Company only come to know who has become the owner of the shares. Suppose Yash were the shareholder, Yash sell the share to Harshvardhan. So in company's book of record, in the place of Yash, Harshvardhan's name will be mentioned. That is the only thing when you buy or sell share in the market. Okay, right. Now then comes, there is one more instrument which is not that very popular. Not so many people of companies use. That is called preference share capital. So preference share capital has a feature of equity as well as dividend. So they get what? Dividend. And in India, preference share capital can be perpetual. That means there is a definite term. Okay. When investor gets back the amount, that is your principal, let's say. That means that is called, there is a term called redemption. That means company will redeem the preference shares at certain point of time. So if I look at nomenclature wise, the share capital will show that share when a company issues share, something like that, will say that, let's say equity share capital of rupees 10, that is called face value, issued maybe at par or premium or discount. So in that case, at par means rupees 10, at premium means rupees more than rupees 10, at discount means less than rupees 10. That's what. Bus, that much only, nothing else. Whereas preference share capital will say that, let's say, maybe for example, 12%. I'm just giving 12% as an example. 12% example, not the every preference share capital 12%. 12% preference share of, let's say, rupees 12%. Let's say, why 12%? I'll say X percent in year. Preference shares of rupees, let's say 100 each face value. Issued at either par or premium or discount, that is okay. Okay. So what is happening difference here? These two prefixes are not there in case of equity share capital. That means it says that at the end of particular year, preference shareholders will be entitled to X percent of dividend on face value. Okay. For example, if the company has issued a share rupees 100 at 10% premium, issue price 110, but they'll be giving a dividend of X percent, suppose 12%, 12% on rupees 100 only. That means at the end of the year, the shareholders of preference shareholders will be getting 12 rupees dividend as such. Similar, then again, in maybe let's 8 years. At the end of 8th year, the preference shares will be redeemed. That means company will give back the money to the preference shareholders, and redemption, unless and otherwise mentioned, redemption will be at 100 rupees face value. That means at the end of 8th year, let's say, if you redeem the life of the preference share, you will get, as shareholder, you will get rupees 100 as your money back. The company redeems that particular share. Whereas in this condition, not there in equity share capital. These are the feature-wise differences. Now the question is that why it is known as preference shares? What is the reason for that? Why the word? They say, why this collaborate? Why this word preference? Why this preference? Preference is with respect to two things: dividend payment and principal repayment in the eventuality of closure or liquidation of company. Okay. Now, if the company has to declare dividend for equity shareholders, company has to first declare dividend for preference shareholders. That's the first preference is given. That is called why it got preferred. They are preferred over the share equity shareholders with respect to dividend payment. Without declaring dividend for preference shareholders, you cannot declare dividend for equity shareholders. That's what. Second thing, on the normal course of time, preference shareholders will be getting their money back at certain point of time, depending on the maturity of the instrument. But let's say company is closed for some reason or liquidated, maybe because of good performance, bad performance, whatever that may be. Company is being liquidated. I mean, company will cease to exist. All those people, everybody, all liabilities has to pay it off. So in that case, first you will give it to, there is a structure. First, the money will go to secured creditors. We discussed that in some class also, secured and unsecured. Then it will go to unsecured creditors, current liabilities, etc., etc. When all the liabilities are taken care, only money left for, if there is any money left for shareholders, then first preference will be given to preference shareholders, and whatever left over after paying up all liabilities and preference shareholders, if there is anything left over, that will go to equity shareholders. So when there is a finally you have to give back the money to the shareholders, first preference will be given to preference shareholders, then anything left will go to equity shareholders. That's why equity shareholders are also known as residual stakeholders of the company. Residual, whatever left, that belongs to them. So that is why it's called preference shareholders. Now I have a quick question. What is the difference between a preference shareholder, preference share, and a bond, which is called a loan? Example of loan. What the period? But bonds will have the same thing. Bonds will also have this nomenclature, like how much interest rate and what the maturity period. Bonds will have those features, no doubt about that. Now, what is the difference between a bond and a preference share? Anyone? Both of them are similar features. Only thing is that in preference share they get dividend, in bond they get interest. That's the only nomenclature difference. But as an investor, suppose potential investor, where shall you go for? Should you go for preference share or equity share? Sorry, preference share or bond or debenture? Anyone?
So sir, one difference is there with bond and preference shares. So first is that bond will be paid before preference share. So in case of liquidation, so that is one of the differences I know.
Very good. So Govinda, please make a note of Ijazur's name. Govinda, did I share with you the attendance register or not? Govinda, are you there?
Yes, sir.
Govinda is there. Yeah, Govinda,
Yes, sir.
you please make a note of Ijazus. Yeah,
So-
any other difference, Ijazus? Can you think of?
Sir,
Harshvardhan is trying to answer. Yeah, please go ahead.
the preference share gives a ownership of the company. Bond doesn't.
No. Shareholders, owners, and equity shareholders. Under exceptional circumstances, preference shareholders may become like owner. They may have owner type, like they may have voting rights later. If there is exceptional cases, other than ordinarily, preference shareholders are not owners of the company. Owners are equity shareholders. They are shareholders, but not owners. That means all shareholders are not owners, but all owners are shareholders. Okay. So when I say all shareholders are not owners, I mean preference shareholders are not owners of the company. Under normal circumstances, they may have ownership rights in exceptional circumstances like liquidation, bankruptcy, etc., default. They may have ownership rights. Like if preference shareholders not vote, they don't have voting right. If they're not, you can't vote, then where is the question of ownership? Correct? Isn't it? Because you can't take part in decision making. Okay, in case of why question of in case of liquidation? Liquidation to interest. What is interest due can be paid? Pankaj mentioned the chart. Okay, liquidation interest can be paid, but when there is a interest due, it will be paid. If there is no interest due, all interest has been paid. Why to pay the interest? They know nothing. Suppose you are liquidating today, and as of now you already paid the interest, then no need to pay again the interest as such. But anyway, you are close to the answer, Pankaj. Very close to the answer.
Sir?
Yeah, yes.
Sir, in case of bankruptcy, maybe the bond will help the investors.
No doubt. We told about that. In case of bond, so in case of bankruptcy, bondholders or loan holders will have the first right to get the money compared to shareholders, preference shareholders. No doubt. If there is anything left over, first you will pay to bondholders, whether secured or unsecured. First secured, then unsecured. Then anything left over, it will go to your shareholders. In that shareholders, preference will go to first preference, then equity shareholders. There is that already discussed. Anything else? Difference between dividend, bond and preference share. Okay, what is dividend, by the way? Dividend is a distribution of profit. That means if the company has not made profit or company does not have any accumulated profit from the previous years, that is called your retained earnings, company cannot declare dividend, even if it has cash also. So to give the dividend, whether it is preference shareholder or equity shareholder, you must earn first profit or you must have accumulated profit. Whereas for interest, it is not like that. Interest is a pre-profit expense. It is an expense. Interest is an expense. It is a charge against income. You find the profit after paying the interest. But dividend is a distribution of profit. Interest is compulsory. You have to make the interest payment. That is compulsory. Whereas dividend is not compulsory. You will declare dividend. Yes, if you make the profit, you will declare dividend for preference shareholder. So there is a situation that in a particular year, so you made the business, you paid interest, then you say your profit before tax is negative. Forget your profit after tax. In that case, you will not be able to pay the dividend for preference shareholders because you have not made the profit. Okay, that is another difference that yes, you will not pay the dividend. You cannot pay dividend unless the company has made the profit. Okay, right. There could be other difference also for the timing. These two, three things you please keep in mind. Okay. Now it depends why shall as an investor, just Harshvardhan, just a minute. Why shall as an investor go for investing preference share or a bond? Suppose two investments are there. One is a bond debenture, another is a preference share. Both of them are giving you, let's say 10% coupon, 10% dividend, 10% interest, as the case may be. And you are choosing, and both of them are likely to pay the interest or dividend. It's not a bad company, it's a good company. So I am investing, I have a choice now. Which one should I go for as an investor? Yeah, Harshvardhan, what is the question you have?
So I wanted to know that equity shareholders can exit at any moment. Similarly, can preferential
Equity
shareholders?
shareholders can exit provided the company is listed. Okay.
Yes, sir.
Preference
Yes, sir,
shareholder
for
also can
listed
exit.
company.
Preference shareholder also can exit if they get a buyer. Equity shareholder is easy because they're listed. So you get the quotes, you get go to market, get the buyers there. Preference shares may not be listed. So you have to find a buyer. If you find a buyer, you can sell the shares. Similarly, if your shareholders shares are not listed also, equity shares, if you find a buyer, you can sell the share and as per the regulations and intimate the company that yes, this share has been sold by me to such and such person. Company will make a note of it. So exit option is there for both the shares, but equity share, if it is listed, it's easy to exit. Preference share is any listed share is easy to exit, and equity share has more liquidity, no doubt about that, compared to preference share. It's a good observation by the Harshvardhan. Okay. So what is my question? As an investor, where shall I go for? Equity, preference share or bond? If both have the 12% interest or 10% interest or dividend as the case may be, where shall I go for? Think about it. In the meantime, let me go to another return. Okay, these are things to be covered. We have to cover up to the, okay, dividend per share. In this case, dividend is declared by the company. We have dividend data. We do not have dividend data, right? So let's say, I don't think we have dividend data. Let's say dividend. Just a minute. Yeah, think about that. What is the question I'm asking? Investor will go for this or that. As an investor, which one will you prefer? Tell me. Anyone? Pragya, which one will prefer?
So not really sure because the returns are equal.
Okay. Please be sure now. What is this? You're disappointing. Okay, anyone? Anjali?
So possibly bonds. In case of liquidation, will be paid first. If so, for preference share, is there a so if I mean they are also going to get paid back in any case, even if they're left with no money.
No. If there is no money, you cannot get anything, right?
For preference, so then bond. If everything else is the
You
same.
cannot get anything. But I said there is no uncertainty with respect to dividend payment or interest payment. There is no uncertainty. Let's say company is healthy. It will declare dividend. It will also pay the interest anyway. That one. So then what shall you do as an investor?
Sir, if the dividends paid are more than the interest that
I
one would.
said both of them are same, 10% on the face value.
So bonds.
Why bonds?
So because they will offer regular interest payment while dividends are.
No, I'm saying there is the company is a wealthy company. Let's say Reliance Industries Limited. Very unlikely they will default, right? Reliance Industries, Infosys. Let's say sub company. Even Tata Motors, Tata Group also loss making company also maybe there. But they'll still honor the obligation. Of course, different dividend they may not be able to write. But let's say a healthy company, Reliance Industry, for example, let's say. Very unlikely they'll not pay the dividend and preference shares. Very unlikely. 0.0000001% of chance that they don't pay. So then what shall you do for? Think over. Okay. So the company has two dividends here. So dividend per share, the declared dividend per share is 8,000 by number of shares. That comes to number of shares we calculated somewhere. What is that? Yeah, here. So 3.20 and 2.80 dividend that declared. So dividend yield is nothing but dividend per share to market price per share. DPS by MPS. That is the normal formula. So nothing is given. So 3.20 by 40.00. But there is a catch here also. So dividend mean how much dividend they got. If somebody has invested 40 rupees per share, then they got 8% dividend on that effectively, which was 5.6% earlier because the price was higher that time. So dividend yield is lower in previous company, now higher, not because they paid more dividend, plus the share price itself has declined because of that. Okay, but there is a catch here. The right formula for dividend will be, in my opinion, dividend yield. If I have to find out, I should take dividend per share of T period and market price per share of T minus 1 period. That means if I say what is dividend yield today, dividend is declared today, then I'll have to compare with the price 1 year before. Assuming that somebody has invested in the share 1 year before, what is the price? On that price, he or she got the dividend of X rupees. That is a correct method of dividend yield as such. So here you do not know the prices of last year or 2 year average price, do not know. So you just took that price as it is as per the exercise. Okay. Right. Then next one, I'll cover this one fast, and if there's time, then I'll cover that. I'll try to answer this question that which one will you prefer, or tomorrow in the beginning I'll discuss that 2, 4, 5 minutes and then go to some other unit. Then we come to call total shareholders return. Okay, that as a shareholder, equity shareholder, what is that you get? You get your return comprises of dividend and change in market price. Change in market price can be negative or positive. Accordingly, the sign will change. What is my change in? Then in that case, if I have to find the formula TSR, total shareholder return, I have to take dividend per share of T plus market price per share T minus market price share for T minus 1 whole divided by what? Market price per share T minus 1. That is the formula which is written known as TSR, also known as TRS. Total return to shareholders or total shareholders return, both are same. Okay. In the existing example, you do not have that data for a, so we have got a separate example here. So if you look at, let's say, okay, let me put some figures here. That dividend per share of one company for last 3 years has been, let's say, 4, 3.5, and maybe 3.2. Okay. And market price has changed, let's say 54, which was 46, and maybe it was 43. So what is my TSR then for the first year? Dividend per share, that is your 3.2 plus change in market price, that is market price today at the end of first year, minus market price last year or beginning of this year, whole divided by what? Tell me which cell? Whole divided by which cell? Please tell me the cell number. Anyone? Divide by what?
So year 0.
Year 0, that is F8, correct? So 15.5%. If I drag it, so TSR has been 15.5, 15.1 to 20. This is from purely from market point of view. So this 26.09% has two components. One is your capital gains. That means you invested in an investment capital asset called share and you got some gain. Another, you got some regular dividend also. So capital gains portion, I can split it also. Capital gains portion is nothing but the change in market price compared to previous price. So divide by previous price, that is this one, and dividend is my dividend upon the last year share price. So if you Sorry, this should have been kept here. So if you sum it up, you get same thing. So whatever you got here, you get same thing here also. Okay, so you can drag it and you get this value. So sorry, you have to drag this also. So you can see here they are matching. Matching, you get true. So you can see that yes. So one can say that how much he or she got at capital gains, how much he or she got dividend. Dividend gain is dividend. Okay, whenever. So 8.70% in terms of dividend and 17.39% in terms of capital gains. Okay, any doubt? There is what is the question left to discuss? I was discussing. What is that question? As an investor, which one will you prefer, right? Somebody has a chart also. What is the chart? If we are unsure of company's future, loan and bond would be better. Anyway, we are sure of that. So I have already answered that question, Pankaj. So tomorrow we'll discuss 4 minutes about that. As an investor, which one will you prefer? And another somebody asked a question towards end when the class was leaving actually. Then one of the students asked that why are you going for so many ratios? Correct? What is the utility of going for so many ratios? Correct? That was question somebody asked me. I don't remember who asked that, but somebody asked me that. Who was that asking? You recall? Can you? Anyway, somebody asked me. So this question and this first other one will. Okay, Pankaj was asking. By now, have you got the answer? By now on your own or not? Pankaj. Pankaj. Oh, Pankaj, you are not. Why are you not speaking? Anyway, so we'll discuss that. So for the today class is over. So with tomorrow, more or less, yes, sir. Different people use different metrics. Different people use different matrices. Okay, so I'll discuss that also tomorrow. Then we'll go to another unit of this class. Okay, so good night. Take care. Bye bye. See you.
Thank you, sir.
Thank you, sir.